Welcome. This is a Delta Intelligence update focusing strictly on Tesla's energy generation and storage segment. We're going to break down the key developments from Q4 2025 and really assess where the business is headed for 2026. Okay, let's just jump right in with the single most important number from the last earnings report. That's $1.098 billion. Now, this isn't just some big number. It's a brand new record for quarterly gross profit, and it's a huge validation of the segment's underlying profitability. So here's how we're going to break this all down. First, we'll cover how Q4 really confirmed the segment's strong foundation. Then, we'll dive into the massive capacity expansion planned for 2026. After that, we'll look at virtual power plants, what we're calling the revenue multiplier. And finally, we'll tackle the big one, the critical margin test that the business is facing. So let's start with the hard numbers from Q4 2025, because they really do solidify this idea of the energy segment becoming the new profit floor for the entire company. You know, when you look at the data here, it's the confirmation across every single key metric that's so compelling. Revenue, up 25%, well ahead of forecasts. Deployments for the full year, up almost 50%. But the real story, the crucial point, is that gross margin, 28.6%. That's what delivered the record absolute profit, and it really validates the whole thesis that this is a structurally high-margin business. And this chart, this just perfectly illustrates the huge strategic shift that's happening. At 28.6%, the energy segment's gross margin is now crushing the automotive business, which came in at 17.9%. This is a fundamental change, right? Energy isn't some side project anymore. It has become the company's margin anchor. Okay, so that's the foundation. Now let's look at where this is all heading, because Q4's performance is being followed up by a massive, and I mean massive expansion of manufacturing capacity to get ready for the next big wave of demand. The plan is to increase total annual production capacity by a whopping 60%. And this growth is almost all coming from one place, the new Houston Megafactory. It's set to add another 50 gigawatt hours of capacity all by itself, starting in the back half of 2026. Now, this Houston facility, it's a $200 million investment, but it's not just about more of the same. It's about next-generation products. The whole factory will be focused on the Megafactory, which is 28% more energy dense than the last one. That's a pretty significant leap in efficiency. But, of course, this kind of dramatic expansion brings up the key question for any investor looking at this. You know, current capacity utilization is running at 56%. So, is there really a deployment pipeline out there big enough to absorb a 60% jump in supply without just stranding a bunch of capital? Well, a big part of the answer to that demand question lies in something called the virtual power plant, or VPP. This is a business model that's now really proven, and it's acting like a powerful revenue multiplier, especially on the residential side of the business. So what is a VPP? Just think of it like a network. It takes thousands of individual home batteries, power walls in this case, and links them all together. They become this single, coordinated power source that can sell energy and stability back to the main grid. And that generates revenue for both the homeowner and for Tesla. And this is why it's such a structural positive for the business. There was a huge regulatory win recently from ERCOT, that's the grid operator in Texas, which basically finalized the rules for these grid services. With over 1 million Powerwalls already enrolled, this unlocks a recurring revenue stream of $100 to $200 per unit per year. That effectively doubles or even triples the economic value of a single Powerwall. It's a game changer. Okay, but with all this positive momentum, you might think it's all smooth sailing. Well, not so fast. This brings us to the central conflict for 2026, because we've had a direct and very explicit warning from management about near-term profitability. This is going to be a major test. And this isn't just speculation. On the Q4 earnings call, the CFO came right out and flagged margin pressure for 2026. I mean, that is a critical signal. It directly contradicts the popular narrative of perpetual 30% plus margins, and it forces us all to recalibrate our expectations for the short term. So the story for 2026 is really a tug of war. On one side, you've got these market headwinds, fierce, low-cost competition, a lot of uncertainty around those IRA incentives in the US, and the threat of tariffs. But on the other side, you have the company's internal tailwinds, the cost benefits of the new Megapack 3, a growing mix of international projects, and that high-margin software revenue from VPPs. So, how are they planning to fight this margin pressure? Well, their primary defense is the new product architecture. Megapack 3 isn't just denser, its design requires 78% fewer connections and is 23% faster to install on site. When you add all that up, it translates to a staggering 40% reduction in total construction costs for these big utility projects. And at the same time, they're playing defense by de-risking the business geographically. I mean, take this huge $275 million deal for a 1 gigawatt-hour project over in Scotland. That's a perfect example. The international project pipeline now makes up over 30% of the total, which is a really crucial hedge against any policy risks that are specific to the U.S. market. So let's pull all this together. What's the new investment thesis? Well, first, it's confirmed. Energy is the company's profit floor and its new growth engine. But, and this is a big but, 2026 has to be seen as a transition year. Management has told us there's a risk of margin compression. Their defense against that is all about executing on the Megapack 3 ramp and growing those international sales. And that really leaves us with the one forward-looking question that is going to define this segment's success over the next 12 to 18 months. Will the huge cost efficiencies from the new Megapack 3 arrive at scale and in time to defend that 28% margin floor against the headwinds that we know are coming?